What factors cause a financial crisis? Hey there! You are watching this because you want to know how to identify a market crash, right? Let's just say, things are about to get pretty exciting. There's a whole world of possibilities waiting for us, and I can't wait to see what unfolds. So, buckle up and get ready for the ride. 3 warning signs. 1. Overvalued stocks. Unusually large stock market bubbles are often seen as one of the first signs of a market correction, as stock markets in the long term always revert back to the mean. Price bubbles have higher equity fundamentals, such as an inflated price/earnings (PE) ratio. The PE for S&P 500 is currently at 26, far greater than the historical average of 19. The S&P 500 PE reached the 30s during the dot-com bubble of early 2000s. During the late 2008, ahead of the Great Recession, the value reached 70. 2. Inverted yield curve. Normally, long-term bonds yield are higher than short-term yields, as investors demand compensation for holding a security long-term. This results in an upward-sloping yield curve. When investors sense economic uncertainty, they tend to invest in more longer-term bonds in hopes of finding safety, increasing their prices and thus reducing their yield. This flattens or even puts a downward, inverted, slope to the curve. Current Bank of England data shows an inverted yield curve for the UK for the midterm. 3. Interest rate increases. Central banks often use monetary policy as a tool to achieve price stability in an economy. Inflation is often dealt with by increasing interest rates. Higher interest rates do curb consumer spending, but often at the expense of the businesses selling goods and services. Increased rates also increase funding costs for businesses. The U.S. Federal Reserve increased its key rate by 25 basis points this month and may potentially increase them further during 2022. Alastair George, chief investment strategist at Edison Investment Research, believes a spike in corporate credit costs is one of the biggest red flags for an imminent stock market correction. For us, the biggest red flag in the very short term is funding stress in interbank markets or a sharp increase in corporate credit costs, both of which reflect fears within the market that there are hidden losses or undercapitalization within the financial system. The best early warning signals for the medium term are indications of financial exuberance, whether that is equity valuations well in excess of historical norms or significantly increased issuance of more speculative securities. What are the early warning signs of a market downturn? Despite all the indicators, there are several external factors that can impact the stock market in either direction. However, identifying these events is often a subject of debate among economists and financial experts. Peter Schiff, CEO of Euro-Pacific Capital, accurately forecasted the 2008 stock market crash in 2006. He stated in 2009 on MSNBC that a market downturn was imminent due to overinvestment and excessive borrowing, and a lack of production and savings. Steve Keen, an esteemed economist and professor, also predicted the financial crisis. In a recent article on The Conversation, he emphasized the importance of the ratio of private debt to gross domestic product, GDP, which rose significantly during both the Great Depression and 2008 financial crisis. He argues in his 2006 report The Recession We Can't Avoid that private debt is a more critical factor in the stock market than inflation rates. Is the stock market headed for a downturn? With conflicting opinions on the cause of a market crash, the outlook for the stock market is uncertain. Peter Schiff believes that a crash is imminent and inevitable. He stated in an interview with Capital.com that it could be even worse than 2008, but the exact nature of the crash is yet to be determined. Alastair George sees a mix of signals and believes it all depends on the actions of central banks. He stated that there have been some signs of credit stress in the banking system following the Russian invasion of Ukraine, but risk appetite has returned recently. However, he pointed out that equity valuations are well above historical norms and there has been an increase in speculative securities over the past year. He believes that it remains to be seen how the stock market will react as central banks raise interest rates and inflation continues to rise. Meanwhile, Oren Klachkin, lead U.S. economist at Oxford Economics, told Capital.com that the economy is not in great shape, but it is far from a recession. He believes that the current economy is in a different place than it was in 1929 and 2008 and still has a lot of underlying momentum. Steve Keen believes that the current inflationary period is caused by supply issues and raising interest rates will only lead to debt payment issues. He stated that the Fed's tools are not equipped to handle this type of inflation and that increasing interest rates will cause a downturn in demand and eventually increase production costs. In conclusion, while there are several factors that can cause a financial crisis, it is important to stay informed and aware of the warning signs, such as overvalued stocks, inverted yield curves, interest rate increases, and signs of financial exuberance. Experts like Peter Schiff, Steve Keen, Alastair George, and Oren Klachkin offer different perspectives on the current state of the stock market, but ultimately, it is up to each individual to make informed decisions and take steps to protect their investments. It is always wise to stay informed, keep an eye on market trends, and diversify your portfolio to minimize risk. Thank you for joining us on this discussion about financial crisis and its potential warning signs. Stay tuned for more informative content on financial and investment strategies.